What happened to SoFi stock? On Tuesday, SoFi released their best earnings beat to date. The company is constantly outperforming expectations, and the stock initially jumped up more than 15%, but then it quickly started to fade. SoFi not only beat analyst estimates, but they absolutely smashed them. They beat on revenue and EPS, and they also raised guidance, leading to analysts raising price targets for SoFi stock. So why is it that a company that just did a triple beat started to drop almost the instant the market opened and has been dropping ever since? In today's video, I'm going to analyze just why this happened and what we can expect going forward. Now, we've got a lot to get through in this video, so I will try to keep this intro short, but if you find any value in this, can I ask you to smash the like button? It takes a lot of time to make these videos, but it literally takes 2 seconds and costs nothing to smash the like button, and it helps the channel out so much. I'm aiming to get 500 likes on this video. Help me hit that goal. Subscribe to the channel if you're new and hit the bell notification so you don't miss out on any new content like this. I want to point out that I'm not a financial advisor and this is not financial advice, so always do your own due diligence. Now let's get into it. So let's get started with what has happened. This is SoFi's latest earnings report, and we can see that adjusted net revenue is up 44% to a record 858 million. The adjusted EBITDA is up 81% to a record 249 million. Fee-based revenue, member growth, and product growth are all up to new records, and management have raised 2025 guidance. In the words of Anthony Noto, we have had an exceptional second quarter, driving durable growth and strong returns through our relentless focus on product innovation and brand building. We have accelerated adjusted net revenue growth to 44% year over year, the highest level in over 2 years, driven by record high new members as well as new products, and an increase in fee-based revenue. And we can see that more clearly here when we look at the investors' presentation for Q2. The record adjusted EPS of 8 cents is the 7th straight quarter of profitability now, while total deposits grew 2.3 billion to nearly $30 billion, and the company recorded GAAP net income of 97 million. To put that into perspective, when we look at the members and products, new members grew by 846,000, up to the record of 11.74 million. And new products grew 1.26 million up to 17.142 million. These are compound annual growth rates of 51% and 53% respectively of members and products. This has been an incredible quarter. There is absolutely no doubt about that. And SoFi have proven their durable growth with the adjusted net revenue and EBITDA, with the adjusted net revenue, EBITDA, and net income all far exceeding previous years, and we can see that they are on a huge upward trend that is showing no signs of slowing down. Financial services has driven a 2x net revenue growth on the year while nearly doubling the contribution margin. SoFi continues to drive strong originations across all loan types, with personal loans, student loans, and home loans all increasing year over year. When it comes to full year 2025 guidance, SoFi have once again revised their guidance upwards. The prior guidance for full year 2025 for adjusted net revenue was between 3.235 and 3.31, and they have revised this up to 3.375. EBITDA of between 875 and 895 has been revised upwards to 960, while the net income has been revised up to 370. Guidance for EPS in a range of 27 to 28 cents has now been revised up to 31 cents. So overall, it's been an incredible quarter for SoFi yet again. But then this happened. While everyone was focused in the morning on SoFi's earnings report, SoFi dropped this. SoFi announced that an underwritten public offering of $1.5 billion of shares of its common stock, and in conjunction with the offering, SoFi expects to grant the underwriter a 30-day option to purchase an additional 15% of shares of common stock offered in the offering. And then very quickly after that, they released this. SoFi announced that it has priced its previously announced underwritten public offering of 71 million shares of its common stock at a price of $20.85 per share, for total gross proceeds of approximately $1.5 billion, with the option to purchase an additional 10.7 million shares. Now, this bit is important. The offering is expected to close on July 1st, 2025. All of the shares of common stock in the offering will be sold by SoFi. So after SoFi absolutely smashed their earnings expectations in the morning, many investors were left wondering what the hell was going on with SoFi stock and why was the stock dropping. But it's very simple. The answer was this big dilution. And although the stock had ran up to $25 in the morning, this dilution was being priced at just $20, so inevitably the stock began to drop. Now, there is some good points to this and some not so good points. Starting with the not so good, obviously the dilution. And it's not exactly insignificant. $1.5 billion is significant. If this was a company with a market cap of trillions or even hundreds of billions, then this would not be a big deal. In fact, it would probably barely even be noticed. But this is a company valued at just $23 billion, so a dilution of up to $1.7 billion is quite a lot, and it will not go unnoticed by investors. The next thing that had a big influence on the markets this week and affected SoFi specifically too is this. The US added just 33,000 jobs in July, and the numbers for the prior months were revised much lower. In fact, the June and May totals were revised sharply lower, down by a combined 250,000 from the previously announced levels. Now, the upside to this is that the weak report, including the dramatic revisions, could put pressure on the Fed to lower interest rates when it meets in September, and a rate cut would be a good thing. President Trump has once again applied pressure on the Fed, stating on Truth Social that Jerome Powell must substantially lower interest rates now. If he continues to refuse, the board should assume control and do what everybody knows needs to be done. Following the jobs report, Trump posted again, calling Powell a disaster. Now, one side to this, monthly job creation has plummeted in 2025. We can see that here. May and June have been revised down to two of the worst months in years, while only October 2024 is lower than July 2025. But this chart is a little bit skewed too, because it looks like there has been a massive downward trend for the past few years, when in fact early 2022 was still recovering from pandemic times, so the numbers are far higher than what would be considered normal. And a better look at this would be to look at the US unemployment rate, and we can see that here. The unemployment rate was still sky high in 2021, and was dropping all through the second half of 21 and 22. In fact, there hasn't really been any increase in unemployment over the past year. Today's rate of 4.2 is exactly the same as it was 12 months ago. However, this is important. An unemployment indicator that includes discouraged workers and those holding part-time positions for economic reasons rose to 7.9%, its highest since March. So think about this for a moment. If people have money, and they spend money and they borrow money to spend money, then this boosts the economy. It boosts companies like SoFi, businesses booming. But if people feel like they don't have the means to actually pay back loans, then they simply won't take loans and they will cut recreational spending. This is bad for the economy and this is bad for SoFi. On the upside though, if this does lead to the Fed reducing rates, then the cost of borrowing could go down and borrowing itself could go up, which would be great for SoFi. But right now, the whole economic situation is uncertain, and it's well known that the markets hate uncertainty more than anything else. Just 3 weeks ago, we had reached a level of euphoria in the market, with the CNN Fear and Greed Index spiking into extreme greed for the first time in more than a year. But within just 3 days this week, this had plummeted back to neutral. Market momentum has shifted to fear, and although stock prices remain in bullish positions, it's hard to ignore the shift that has taken place in options calls and puts, while the VIX has spiked up to a 6-week high. Looking at MarketBeat, we can see that the consensus price target for SoFi stock is $18, with a high of 26 and a low of just 12. But analysts are more divided than ever, because based on 21 analyst ratings, 7 rate the stock as a buy, 3 rate this as a sell, and 11 rate this as a hold. But after the earnings report, analysts have been raising their price targets. Morgan Stanley, Barclays, and Mizuho all raising their price targets significantly, and Rothschild initiated coverage with a price target of $20. Now, for those of you that follow the channel, you will know that I'm a big fan of seeking alpha when it comes to doing my research. And it's been a very long time since I've seen anyone give SoFi a sell rating on here. For a long time, it's simply been full of buy ratings and strong buy ratings with the occasional hold. But this article here has issued the first sell rating that I've seen for a long time. For context, this is someone who wasn't overly bullish on SoFi to begin with, and issued hold ratings all throughout 2024 while the stock was rising. Now, I'm not going to go into this article in detail because I am still bullish on SoFi, but there are risks too. JR Research points out that the valuation of 61 times forward EPS suggests years of optimism are already priced in. The fact that over 50% of revenue is still loan driven, exposing SoFi to cyclical and credit risks, and the current valuation may be challenging to justify if SoFi fails to lift its post-2026 outlook, suggesting a normalization phase could follow. So let's be fair here. SoFi is always exposed to economic and credit risks. It's part and parcel of the industry. And considering the quarterly reports that we've seen so far in 2025, it is also highly likely that SoFi will lift its 2026 outlook. Now, this article does praise SoFi for posting yet another incredible quarter. And it also highlights that SoFi has made a great habit of smashing Wall Street estimates time and time again. But despite that, suggests that the upward surge is primed for digression. Given SoFi's decision to dilute on the surging valuation in executing a $1.5 billion offering, now I will say one thing here. Nobody likes to see dilution. But the best time to dilute is always when a stock is high. For example, if SoFi had decided to raise $1.5 billion this time last year, when the stock was only $6, then the amount of shares they would have needed to issue would have been more than 3 times what was announced this week, and it would have been detrimental to the stock. In fact, if SoFi had done this last year, it would have destroyed investor confidence, and I highly doubt the stock would have ever gone above $10, but here we are today. SoFi is still in a very strong position, but there are certainly risks and macro risks that should not be ignored at a time now when the overall market has dropped back significantly from extreme greed and the VIX is beginning to spike. But guys, what do you think? If dilution had to happen, was the timing of this dilution good or bad? Let me know your thoughts in the comments below, and always do your own due diligence. Remember that I'm not a financial advisor, but if you enjoyed this analysis, then please like and comment, and I'll catch you in the next video.